Okay, let's unpack this. We've got a stack of sources here, and they're all detailing a pretty massive systemic shift in the U.S. health insurance landscape.
It's a huge shift. And the fallout, I mean, it's happening right now as we speak. The open enrollment period is just wrapping up.
And it's more than just a shift, isn't it? The data we have here, it paints a very, very clear picture of a measurable consequence that follows a political decision.
Exactly. We are literally witnessing the instantaneous impact of a policy expiring and how that hits millions of American household budgets.
Right. So the core topic today is this recent and frankly dramatic contraction in the Affordable Care Act, the ACA plan enrollment.
And we know what's driving it. It's all about the expiration of that crucial federal financial assistance.
The enhanced premium tax credits that had been, protecting consumers for the last few years.
So our mission for you, the listener, is really to provide that critical context. We need to move past the simple, kind of scary headlines and really understand the history here.
Yeah, the mechanics of these subsidies, the exact financial pain points people are feeling right now, and then the politics of it, the high-stakes maneuvers that got us to this exact moment.
This moment of just abrupt cost spikes.
And when we talk about a contraction, we're not talking small numbers. The initial data shows 1.4 million fewer people enrolled compared to the same time last year.
That's staggering.
It is. That's not a marginal correction, That is a population-level drop in a very short time.
And it strongly suggests that the whole concept of affordability has just, well, it's hit a severe wall for a massive segment of the population.
Okay, so let's start with the hard data. Let's dig into those numbers because they really do set the scale for this whole conversation.
Let's do it.
If we look at the overall enrollment figures from the Centers for Medicare and Medicaid Services, or CMS, we see the total number of consumers who've selected an ACA plan this year is, 22.8 million?
It is. And that number on its own might not mean much until you put it right next to last year's.
Which was?
24.2 million.
Yeah.
At the exact same time.
So that's a 1.4 million person drop. Just gone.
1.4 million fewer people selecting plans. It's incredibly significant. It demonstrates that the second that fiscal support was withdrawn, the market just immediately started to shed users.
It's such a clean correlation, isn't it? The subsidies lapse and poof, the people disappear. But what really grabs my attention in the source material isn't just that total drop, it's who isn't signing up.
The new customers.
Exactly, the new customers. This is often described as the bellwether for market health and accessibility.
The dip in new customer acquisition is, in many ways, an even stronger indicator of the future of the market than just the overall retention number.
How so?
Well, when an insurance marketplace is healthy and it's affordable, it pulls in fresh blood, new people. And last year, the marketplace drew in 3.9 million new customers by this same point in January.
Almost 4 million new people. And this year?
This year, that number has just plummeted. It's down to 2.8 million new customers.
Wow, so that's a drop of 1.1 million new signups.
1.1 million.
So of the total 1.4 million drop, 1.1 million of that is just new people who looked at the prices and said, nope, not for me.
That's right. It suggests two really important things are happening. First, as you said, new people are clearly balking at the increased prices and deciding not to enroll at all. That's the immediate barrier to entry.
And the second thing.
The second point is a little more subtle. If 1.1 million of the 1.4 million drop is from new customers who never signed up, that leaves about 300,000 existing customers who looked at their new bill and just didn't renew.
So you have both a retention problem and a massive failure to attract anyone new.
Precisely. You're failing to attract the very people who are driving the market's growth during that enhanced subsidy era.
So let's zoom out a bit. What does the absence of these 1.1 million new people do to the overall risk pool? I mean, typically, people newly entering the market are younger, right? Maybe healthier.
That is a crucial insight. Yeah, when new, generally younger and healthier people join an insurance pool, they help balance the risk. They keep the average cost of claims down for everybody.
Because they're not using it as much.
Exactly. So when you lose 1.1 million of these potential low utilizers, the risk pool itself becomes sort of older and potentially sicker by comparison.
Which can create pressure for, even higher premiums in the future?
It's a real danger. It's a contraction that makes the entire market less stable. It's a vicious cycle.
We should probably clarify the timing here, too. These CMS numbers, they reflect signups through the federal exchange, healthcare.gov, up to January 3rd.
Right, and through the state-run marketplaces up to December 27th. And that timing is everything for this deep dive.
Why is it so critical?
because most of those enhanced subsidies, they officially lapsed right around the end of December 2025.
Ah.
So the enrollment decisions that are being captured in this data, the selections people made or didn't make in early January, were made in the immediate, agonizing wake of seeing their new, much higher premium costs.
So millions of people were opening their renewal notices or logging into the marketplace and just getting slammed with sticker shock in real time.
That's it exactly. They aren't responding to some projected cost increase for next year. They are responding to the actual current cost they have to pay to enroll by the final deadline.
Which is Thursday, January 15th, the day all this news is breaking.
Precisely. This drop isn't hypothetical. It's a real-time crisis in affordability. And we see this trend confirmed in local reports, too, which helps ground this sort of abstract national data.
Yeah, the sources cite Illinois, for example.
Right. Illinois specifically saw approximately 800,000 fewer people enrolled so far compared to this time last year. That's as of January 3rd.
Wait, 800,000 in Illinois alone? That's more than half the entire national loss.
It is. It suggests that Illinois was either disproportionately dependent on those enhanced subsidies, or maybe their state reporting just captured that cost shock more aggressively.
But either way, it really challenges any idea that the marketplace could just sustain itself without that maximum COVID-era level of aid.
It connects back perfectly to our initial point. A huge portion of the ACA marketplace population, those 1.4 million people who just vanished, were clearly highly price sensitive.
And when the aid was withdrawn,
The market immediately contracted. So the natural next question has to be, why was this specific enhancement so successful that its absence created this kind of collapse?
which leads us right into understanding the mechanics of the subsidies themselves.
Let's get into the plumbing of it.
So let's dig into that plumbing. We know they're officially called premium tax credits, or PTCs, but that word credit can be a little misleading for people, can't it?
It can. It makes it sound like a rebate you get on your taxes later, but that's not how it works.
Right.
The whole goal of the premium tax credit is to reduce your monthly payment, your premium right now. They are immediate upfront government payments made directly to your insurance company on your behalf.
So it lowers the bill before you even see it?
Exactly.
Yeah.
But to really understand this collapse, we have to understand the calculation benchmark they use.
Okay, the benchmark plan. We hear that term used all the time, but what exactly is it and why is that one the standard?
The benchmark plan is typically defined as the second lowest cost silver tier health insurance plan available in your specific region.
So not the absolute cheapest plan, but the second cheapest. And why the silver tier?
The silver tier is crucial because it offers what's called an actuarial value of about 70%. That just means the plan is expected to cover about 70% of your medical expenses. It's a solid, middle-of-the-road plan. And the government uses the cost of that specific plan as the yardstick for calculating how much help you get.
So if the government wants to make sure you don't pay more than, say, 8% of your income for insurance, they calculate that 8% against the cost of that specific silver plan.
Precisely. Now, these subsidies existed in the original 2010 ACA, but they had some really severe limitations.
They're structured to phase out pretty sharply above a certain income level. I think it was 400% of the federal poverty line.
Exactly. Above that threshold, you got nothing. Zero subsidy. It didn't matter how expensive your local premiums were.
Which created the infamous subsidy cliff, right? Where earning just $1 too much could make your insurance premium jump by hundreds or even thousands of dollars overnight.
Yes. And that brings us to the crucial change. The COVID-era enhancement. This was part of the American Rescue Plan and later the Inflation Reduction Act. And this enhancement had two main functions that just drastically changed the entire marketplace.
Okay, let's break down that first function. Increasing the aid for people who are already eligible.
So the first thing it did was significantly increase the generosity of the subsidy for everyone who was already below that 400% poverty line. For instance, the lowest income folks, who might have had to pay 2% of their income before, now they were paying 0% or something very close to it.
So the government was just covering a much bigger chunk of the monthly bill for everyone who was already getting help.
A much bigger chunk. Essentially, if you qualified before, you got a massive discount on top of your existing discount.
Okay, so what was the second function? You said that was maybe even more impactful.
The second function, and this is what really expanded the market and drove that 1.1 million new customer growth we talked about, was the complete removal of that subsidy cliff.
They got rid of it.
They got rid of it.
Yeah.
The enhancement mandated that no one, and this is key, no one, regardless of their income, would have to pay more than 8.5% of their household income toward the premium of that benchmark silver plan.
That is the key shift. So that meant a higher income family living somewhere with crazy expensive health insurance. Like a self-employed couple making $150,000 a year, but facing a $30,000 annual premium.
Which is not unheard of.
Right.
Right.
Suddenly, they could qualify for a ton of government help because $30,000 is way more than 8.5% of their $150,000 income.
And that's exactly how it expanded eligibility to a whole new demographic.
Yeah.
The middle and upper middle class who are just getting crushed by high market premiums. This income protection was the foundation of the market growth we saw.
So when we say the enhancement expired, what we really mean is that both of those things went away. The extra generosity for lower income people and the elimination of that income cap for the middle class, they both just reverted back to the old pre-COVID rules.
That is the core of this financial shockwave.
Yeah.
Let's use a quick conceptual example just to really visualize what the consumer went through.
Good idea.
Imagine a middle-aged, self-employed couple. Let's say they make $75,000 a year, which under the old rules is just a little bit above that 400% poverty line threshold.
Okay, so $75,000 annual income. Pre-COVID, they hit the subsidy cliff. No help.
Right. But under the enhanced rules, let's say their monthly benchmark premium is determined to be $1,800. Now, that's far more than 8.5% of their monthly income.
So the government steps in.
The government steps in with a massive subsidy.
Right.
Maybe they only have to pay $400 a month out of pocket, and the government covers the other $1,400. That's a feasible budget item.
Okay. Now, the enhancement expires. What happens to that same couple on January 1st?
Because they make more than 400% of the poverty level, they instantly fall right back over that subsidy cliff. That government contribution of $1,400 per month, it just evaporates.
Okay.
Completely.
So they're on the hook for the whole thing.
They are now responsible for the full $1,800 gross premium themselves, even though their income hasn't changed one bit. Their bill just jumped from $400 a month to $1,800.
And that is the jump that we are now seeing reflected in the data. It's not inflation. It's a policy hammer blow.
It is. And it sets the stage perfectly for this next section, where we put some really hard and frankly shocking numbers to that spike.
This is where we have to reconcile the numbers, because we have some data points that seem to conflict, and they need some careful explanation for you. On one hand, you have the CBO estimating pretty moderate increases.
Right.
And then on the other, you have the KFF estimating absolutely massive increases for individuals. So what's going on here?
Let's start with the Congressional Budget Office, the CBO, because their numbers reflect the sort of general economic trends of the healthcare market as a whole. They were estimating what would happen to the gross benchmark premiums.
So that's the sticker price. Before any subsidy is applied.
Exactly. And the CBO projections were a 4.3% increase for 2026 and a 7.7% increase for 2027.
And if you just hear those numbers in a headline, you might think, okay, that's high, but it's manageable.
But those low to mid single-digit percentages are incredibly misleading when you're talking about subsidized insurance. Those are just market inflation estimates. They do not reflect the change in what the consumer actually pays out of their own pocket.
This is the critical distinction for you, the listener. The price of the plan isn't just rising 4%. It's that the consumer share of that price is skyrocketing.
Because the government's protective firewall has been completely removed.
That firewall being the enhanced subsidies. So if we then look at the people who are relying on that firewall, that's where the analysis from the Kaiser Family Foundation, the KFF, comes in. They focused on the net cost.
Yes. The KFF analysis drilled down into the consumers who are relying on that subsidy to keep their payments below that 8.5% income cap. And this is the aha moment.
That's the big one.
KFF found that people receiving financial assistance would see their premiums rise by an average of 114%.
114%. I mean, you cannot stress this enough. That is not a measure of medical inflation.
Not at all.
It is purely a measure of the government removing its checkbook from the equation.
It is purely the policy impact. For millions of families, their premiums have literally more than doubled overnight, simply because the formula determining their out-of-pocket share reverted to a much harsher one.
So let's translate that massive percentage into a tangible cost for you. What does that 114% increase actually mean in hard dollars?
Well, the KFF analysis projected that the average monthly premium for a person who was reliant on that subsidy would jump from $888 in 2025.
Which was the subsidized lower amount they were used to paying?
Correct, and that would jump to $1,904 in 2026.
That is over $1,000 extra per month. That's $12,000 a year, just for the premium.
For a family, that's like adding a second mortgage payment. or a brand new car payment to their monthly budget. It completely restructures their finances.
And we don't have to just rely on these national projections, do we? The sources give us regional data that really verifies this reality on the ground.
Right. Take the Texas experience, particularly in the Houston area. It's a huge market.
And the health agents in Houston are reporting that premiums in Texas have jumped by about 35% or more across the board. And that's even for people who are still getting some subsidy under the old rules.
And the specific family anecdotes in the sources make it just unavoidable. We saw the example of a family of 4. They were previously paying around $600 a month in 2025.
Okay, $600 a month, manageable for a family.
And then, following the expiration, that same plan, with the exact same coverage, jumped immediately to $1,000 a month.
That's a $400 increase, a 66% spike, which sits right between that local average and the maximum 114% KFF projection. It's tangible proof this price shock is real.
And furthermore, we have to look at the specific demographic details that were highlighted in the source material. It was noted that about 1 million Texans with ACA plans are over the age of 45.
And for that group,
Many of these individuals will now be paying monthly premiums that exceed the $1,000.
the impact on that 45-plus demographic seems uniquely painful. This is a group that's often making too much money for traditional aid, but they're also at an age where medical needs start to increase significantly. Insurance is a crucial part of their financial plan.
Their need for comprehensive coverage is just higher. But without that enhanced subsidy protection, they are forced to absorb the highest gross premium rates the market offers.
And this group includes a lot of early retirees or self-employed professionals.
Exactly. The very people who were specifically brought into the market by those expanded eligibility rules. And now they are the first ones facing this unbearable cost increase. The financial stability they were relying on to plan their later years, it vanished.
And this isn't just an economic story, it's a political story. The expiration of these subsidies, it wasn't some accidental omission in a budget.
No, not at all.
It was the central high-stakes political sticking point that defined government spending negotiations for weeks. We have to remind you, the listener, that this was a core factor in the longest government shutdown in U.S. history, which dominated public discourse back in October and November.
It's crucial to understand that healthcare funding became the key leverage point because that December expiration date was looming. Both sides knew what the cost would be to millions of families if they failed to act, which gave the issue immense political weight.
So let's detail the Republican position during that shutdown debate based on what our sources are reporting.
Well, the Republican argument was essentially that the pandemic-era expansions had achieved their purpose. They addressed a temporary crisis, but continuing them now represented an excessive and unsustainable expenditure that was distorting the market.
They saw it as, social engineering rather than necessary healthcare support.
That seems to be the argument. Their strategy was to decouple the healthcare funding from the core function of government.
So they tried to get Democrats to fund a temporary spending bill that explicitly excluded the expiring ACA subsidies.
Right. And they promised, we should note, that they would discuss ways to continue them later on, but only after the immediate crisis of the shutdown had been averted.
Which the Democrats categorically rejected.
They did. Their position was very firm. They insisted on extending the premium tax credits as an absolute non-negotiable part of any bill to end the government shutdown.
And they warned that separating the funding would guarantee the very outcome that we are now discussing. Massive premium spikes, people dropping coverage.
The political tension was just enormous. That shutdown dragged on for a significant period. So what was the ultimate compromise?
In early November, the Senate, which was facing just intense pressure, reached a bipartisan deal to end the shutdown.
But here's the critical legislative detail. The compromise bill, while it ended the immediate funding crisis, deliberately did not include any of the Democratic demands on healthcare funding. The extension of the ACA subsidies was stripped out of the final bill.
So despite all the warnings and all the leverage the Democrats theoretically had, they ultimately failed to get the subsidy extension into that must-pass funding bill.
Yes. The sources note that 8 Democrats actually broke ranks and voted with the Republicans to pass that temporary spending bill.
What was their justification for that?
Reportedly, it was the need to end the shutdown crisis itself. They wanted to mitigate the broader economic and security risks of a stalled government, and they were trusting promises of future negotiation rather than holding the line just on the ACA provisions.
Then what were the immediate consequences of that vote?
The bill passed the Senate, then it passed the House, and the government funding lapse ended. But the ACA subsidy issue was left entirely unresolved.
So the policy decision had effectively been made. Through inaction, through stripping those provisions out, the enhanced subsidies would expire in December.
And that led directly to the cost spike we just analyzed.
Were there, as promised, any subsequent efforts to fix this? Did the political system try to honor the deal made to those dissenting Democrats?
There were efforts, but they were largely, you could argue, performative, or they simply failed. Sources told various news outlets that Republican leadership had promised to allow a vote on an ACA-related bill of the Democrats' choosing in December.
A gesture, perhaps, to manage the political fallout.
Perhaps. But those subsequent efforts failed to gain the necessary traction. Earlier this month, a pair of competing health care bills, one from each side, which just shows how far apart they still were, failed to advance in the Senate.
Total gridlock.
It was. Now, we did see the House pass a Democratic-led bill earlier this month that would extend the enhanced premium tax credits for 3 years. This was a kind of a last-ditch effort.
Essentially an acknowledgement of the crisis that we're now seeing in these enrollment numbers.
Exactly. But given the Senate's recent history, the pressure of the shutdown, the bipartisan failure to include the measure, the subsequent failed votes, the fate of that 3-year extension bill in the Senate remains highly uncertain.
So it seems the political machinery just could not find a sustainable compromise before the deadline passed.
And before that financial shockwave hit the American consumer. And that failure isn't abstract. It translated directly into that 114% cost increase and the 1.4 million drop in enrollment we reviewed earlier. The legislative impasse directly created the financial hardship millions are experiencing right now.
Okay, so let's pivot from the policy fight to the individual's fight. We've established that premiums for these enrollees have more than doubled on average. So what does that massive price hike force people to do on the ground? What are the forced choices facing the 22.8 million people currently enrolled and the millions more who just decided to drop their coverage?
The sources really outline 3 incredibly difficult scenarios, and none of them represent a positive outcome for the consumer. They all reflect a kind of triage mentality brought on by severe budget stress.
Okay, what's the first choice?
The first and simplest choice is just finding a way to pay for the more expensive existing plan.
Just eat the cost.
Just eat the cost. And this might sound straightforward, but when you're absorbing an extra $12,000 a year, it requires serious cuts to other essential spending.
Right, we're talking savings, education, housing, even food.
It maintains your coverage, yes, but it severely compromises your overall financial security.
Okay, but if you can't absorb that cost, the second choice is to downgrade your coverage. You sign up for a less expensive plan, which, reduces the monthly premium, but that always comes with a trade-off.
And the trade-off is almost always significantly higher deductibles and out-of-pocket maximums. So a consumer who is paying, say, $400 a month for a good silver plan with a $1,000 deductible,
Okay.
they might be able to find a bronze plan for $700 a month, which is still a big increase. But now that bronze plan has a $7,000 deductible.
Let's really emphasize what a $7,000 deductible means in practice for you, the listener. It means you are paying $7,000 out of your own pocket before the insurance company contributes a single dollar to your medical costs.
Except for maybe some preventative services. But for everything else, you're on your own.
It fundamentally changes what the insurance is for. I mean, if you're managing a chronic condition or you need regular specialists or prescriptions, that policy becomes virtually useless.
You're really only insured against a true catastrophe, a major car accident, a heart attack, something where costs might exceed $50,000. For everything else, you are effectively self-insuring until you hit that massive deductible limit.
So it's a lower monthly payment, but your access to actual care is critically restricted.
It is. And that leads to the third and most alarming choice, which feeds directly into that 1.4 million enrollment drop. And that's simply dropping health insurance altogether.
You're just deciding to gamble on your continued good health.
And the sources confirm this is exactly what's happening. We have that poignant quote in there. Some families were waiting until the very last minute to see if the extension would pass politically.
Hoping for a reprieve.
Exactly. And when it failed, they decided not to get health insurance because, as one family stated, it's just too expensive right now. They're actively choosing financial solvency over health security.
And for those who are truly at the lowest rung of the income ladder, the safety nets they're minimal, right? We noted that very specific low-income option in places like Harris County, in Houston.
Right, but that only applies to people making less than $20,000 a year.
So it serves a tiny, already profoundly vulnerable sliver of the population.
We have to underscore the lack of immediate, robust options for The vast majority of the 1.4 million people who just dropped their coverage, or the millions more who downgraded to those high-deductible plans, they have been cast back into the status of the uninsured or functionally underinsured.
Which raises the critical question that we alluded to earlier. What happens when those 1.4 million people, or the people on those high deductible plans, actually need serious medical care?
Well, the U.S. healthcare system has an ethical and a legal mandate here. Hospitals, particularly emergency rooms, are required by federal law, it's called the Emergency Medical Treatment and Active Labor Act, to stabilize anyone who presents with an emergency medical condition.
And that's regardless of their insurance status or their ability to pay.
Correct. So the care is rendered no matter what. The patient leaves, hopefully stabilized, but now they're saddled with massive medical debt.
And those bills just go unpaid.
Largely, yes. We are talking about billions and billions of dollars in uncompensated care that hospitals are now forced to absorb.
And this is where that broader societal ripple effect comes in. This connects the political failure in Washington right back to every single person listening to this deep dive, even if you have a great plan from your employer.
Yes. The sources explicitly warn that when hospitals absorb these massive amounts of unpaid bills from the uninsured, those costs don't just good-like. They don't vanish into the ether.
Hospitals are businesses. They have to cover their operational costs somehow.
And those costs are often inadvertently passed on to all other consumers.
So hospitals raise the prices for procedures, services, and tests that are charged to insured patients. They effectively use the insured pool to cover the debt that's generated by the uninsured pool.
That is precisely the warning. The expiration of the subsidies, which was ostensibly done to save the government money, could ultimately increase the total cost of health care for everyone insured and uninsured alike through this hidden systemic inflation.
It's a truly vicious cycle. Higher premiums force people off insurance, which increases the uncompensated debt at hospitals, which then raises overall healthcare costs, which in turn leads to even higher growth premiums for the insured next year.
It undermines the very market stability that the original ACA was designed to create. The political impasse has created a self-defeating economic mechanism.
And for you, the listener, this means the financial consequence of this legislative failure doesn't stop with the person who lost their subsidy. It will inevitably filter into your employer-sponsored plan's premium increases, into your deductible, and into the price you pay for basic medical services. We are all now, in a way, contributing to covering that $12,000 annual premium gap left behind by those who couldn't afford to renew. So when you step back, we started this deep dive with a startling figure, a 1.4 million person drop in ACA enrollment in just a matter of weeks.
With that corresponding 1.1 million drop in new customers, which is destabilizing the whole risk pool.
And we quantified the financial shockwave. We showed that the lack of a political resolution on these enhanced tax credits pushed the cost of health insurance for subsidized enrollees up by an average of 114%.
And this investigation really revealed a perfect storm. It's the immediate, measurable impact of that lapsed COVID-era financial aid,
That mechanism that kept costs below 8.5% of your income.
colliding with this intractable political conflict. And that collision forced millions of Americans to face these stark, painful financial choices this enrollment season.
Pay double the premium, risk a catastrophic plan with a huge deductible, or just abandon coverage entirely.
What we have definitively shown is the transition from a highly abstract policy debate in Washington to a very immediate, tangible consumer crisis.
The evidence seems clear that the enhanced subsidies were not some optional accessory. They were the essential fuel for stability and growth in this marketplace.
And without them, the market is rapidly contracting, and the costs are being absorbed by the most vulnerable consumers first.
So we'll leave you with this final provocative thought, and it builds directly on the source material's conclusion about unpaid bills and that ripple effect.
If the central stated goal of the original Affordable Care Act was fundamentally to reduce the burden of uncompensated care on the system, to stabilize hospital finances, and ensure fewer Americans face financial ruin because of an illness, what trajectory are we truly on now that 1.4 million people have already dropped their coverage?
And more pointedly, if the average monthly premium for those who were subsidized just jumped to nearly $2,000, what will the enrollment data look like in 6 months? Will we see 3 million, 5 million, or even more people forced out of the market? And what systemic costs will that impose on the entire healthcare economy? This is the knowledge you can now carry forward and explore.